All right, in this lesson, we're going to be talking about why you need to invest. So the first thing to note is that while you're just holding onto money in a savings account or as cash in your home, the value of your money is actually going down because of inflation. So what is inflation? Inflation is just when things get more expensive over time. So as an example, as a little kid, I could buy a cheeseburger at McDonald's for 39 cents. Now that same cheeseburger is at least $1. Same thing goes for like eggs or milk or coffee. Like all these things were a lot cheaper back then, but because of inflation, things are more expensive now. And looking at a graph here from worlddata.info, you can see that the average inflation rate was between 3.8% between 1960 to 2021. Normally, the government wants us to be at a 2 to 3% inflation rate. That just shows that the economy is growing and things are getting slightly more expensive over time. And as you can see from this graph here in 2021 and 2022, the inflation rate actually went up by a lot. So we're hitting like 8%, 9%, and obviously it's not sustainable because people's raises aren't going to 8% a year. But the fact of the matter is things are around 8 to 10% more expensive than they were last year. So all this to say is if you're just holding onto money, then the value and the amount that that dollar can go doesn't go as far because of inflation. So again, as an example, if you had $100 back in 1980, that could buy a lot more things than you could with $100 here today in the 2020s. Now by investing, you're actually hedging against inflation because the money that grows is an exponential growth curve. So investing lets you grow your money exponentially to let you grow your net worth and savings. So here's an example of what exponential growth looks like. So imagine one scenario of just saving $500 a month for 10 years. So $500 a month times 12 and then times 10 again, you're going to get $60,000 after 10 years of saving $500 a month. That's not too bad, right? $60,000, not bad. But can you do better? And the answer is yes. So imagine another scenario where you're investing $500 a month for 10 years, but you're also investing it so that it gets an average of 8% annual return. So we say average because things go up and down. You're not really always guaranteed an 8% return every year. But 8% is the average return that we've seen in the total stock market over the past 100 years or so. If you just invested in something like that, then over that same time frame and investing the same amount of money, you'll end up with $90,641. So that's a lot. That's like 50% more than just saving straight up. And again, you can see all that on the graph on the right as well, with how the numbers break out. Now, imagine continuously doing this for another 30 years. So after 40 total years, your end balance will be $1.62 million. And that is the beauty of exponential growth because you only contributed $240,000 of that money. Your interest and the gain is $1.38 million. So again, you saved $500 a month and you put in $240,000, but you got back an extra $1.38 million and your total balance is $1.62 million. So again, this is the beauty of investing. This is the beauty of an exponential graph curve. We can see on the right here, your contributions in the beginning make up a significant amount of total gains. But as time goes on, this dark blue line here far surpasses the amount that you're continuously contributing and it makes up a majority of your total balance. And this spread only gets longer and wider as time goes by. So that's why people always tell you, the sooner you invest, the better you're going to be. Because just over time, this exponential part takes over what you contributed. So yes, invest early, invest in things that give you steady returns, and you'll be super wealthy over a long period of time. Now in the next few lessons, we're going to go over different types of investing, different strategies. This lesson was just to give you some exposure into what investing is and why people do it and why it's so important that you do it as early as possible.